On June 1, 2023, the United Arab Emirates enacted a federal corporate tax, ending a decades-long period where business profits were largely untaxed. While creating a new stream of domestic revenue, the primary driver for this change was a response to shifting international regulatory standards. The catalyst was the Organization for Economic Cooperation and Development, specifically their project on base erosion and profit shifting, or BEPS. BEPS originated as a 15-point action plan developed by the OECD in partnership with G20 nations in 2013 to address gaps in global tax rules. These rules specifically target multinational companies that artificially shift their profits from high-tax jurisdictions to low-tax environments, where they have little or no actual economic activity. By adopting these standards, the UAE has synchronized its domestic laws with this global framework, ensuring its financial system meets the transparency requirements of the modern international economy. Globalization has eroded economic borders. Modern businesses can operate supply chains, deploy capital, and generate revenue across multiple countries simultaneously, but the legal power to tax that revenue remains strictly geographically bound. Sovereign nations can only enforce taxation within their own defined borders. This creates a direct jurisdictional conflict. When a company from country A earns income from an operation in country B, both nations may claim the right to tax those same profits. To navigate today's corporate structures, professionals must master the two rules of jurisdiction and the specific treaties used to resolve the disputes between them. Without a system to resolve this friction, the cost of overlapping taxes would make most cross-border trade mathematically unviable. We look to the first foundational rule, residence-based taxation. Under the residence rule, a country taxes an entity's global income, regardless of where it was earned, based purely on where that entity is incorporated. Economists in developed capital-exporting nations generally favor this model. They argue a resident's investment decisions abroad should face the same tax rate as investments at home to maintain economic efficiency. The second pillar is the opposing framework, source-based taxation. Source taxation focuses on the geography of the profit itself. It asserts that the country providing the opportunity and infrastructure should have the primary right to tax it. Developing nations rely heavily on this model to ensure they collect revenue from foreign investors who utilize their local resources and markets. Because no country is willing to surrender its tax revenue, a global system based on only one of these rules is impossible, leading to the inevitable problem of double taxation. This chart shows the impact when these two jurisdictions collide. On the left, country A applies a 30% residence tax. On the right, country B applies a 20% source tax. We have a resident of country A who earns exactly $100 from a business operation located inside country B. Country B asserts source jurisdiction first. It taxes the $100 at its 20% rate, leaving exactly $80. Then, country A asserts residence jurisdiction over the global income. It taxes the original $100 at 30%, taking another $30. After both countries apply their independent rules to the same income, the taxpayer is left with only $50. This results in a 50% effective tax rate, simply because the jurisdictions overlapped. This overlap acts as an artificial barrier, punishing businesses for expanding their operations into foreign markets. To correct this, nations enter into double taxation avoidance agreements, or DTAAs. These agreements provide relief through foreign tax credits, which account for taxes already paid in one country when filing in the other. The first method is the exemption method. Here, one country agrees to completely exempt the specific income that has already been taxed by the other. The second is the tax credit method. The residence country taxes the global income, but subtracts the exact amount of tax the business already paid. The UAE has aggressively pursued this specific framework to facilitate trade, securing over 190 of these agreements with other nations. These treaties establish the legal priority between sovereign nations. They prevent the same dollar from being taxed twice, while allowing tax authorities to exchange the information necessary to catch evasion. To keep these complex agreements consistent, countries use standardized model tax conventions drafted by the OECD and the United Nations. It is helpful to read a DTAA as a partnership agreement between two contracting states, where each party defines exactly when they will relent their taxing rights. This architecture is generally organized into 31 articles that categorize every major form of international income. Articles 1 through 5 define the scope. They determine exactly which people and taxes are covered and what constitutes a permanent establishment. Articles 6 through 22 are the substantive provisions. These specifically allocate jurisdiction over different assets, including business profits, dividends, and royalties. The final sections establish methods for eliminating double taxation, rules for non-discrimination, and procedures to resolve disputes. This 31-article blueprint provides the coordination necessary for two sovereign nations to integrate their economies without creating a tax penalty for their businesses. Returning to the UAE, we can see how these frameworks have repositioned the nation's economy. The timeline has been rapid, from signing the OECD Convention in 2017 to the enactment of the Comprehensive Federal Corporate Tax Law of 2022. The strategy has shifted away from simply offering a zero-tax environment without international oversight. By building a vast DTAA network and enforcing transfer pricing regulations, the UAE now provides multinational operations with a stable, predictable legal environment that is recognized globally. By aligning with source, residence, and BEPS compliance, the UAE has solidified its position as a transparent and reliable hub